This is Bazaar Morning Call, broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's Tuesday morning. We are coming to you as always from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant. Good morning, Nigel. Well, it doesn't feel like a Tuesday morning because you have a holiday tomorrow, but midweek holidays, right? So always cheerful, but not so cheerful for the market considering the kind of sell-off that we've seen lately.
Well, that's right. Overnight cues as well, not too supportive, and we got a bit of a challenge ahead of us. But let's hope that there is some kind of recovery from the low point of the day, Prashant.
Absolutely, and I think it's all geopolitics more than anything else. And we, yesterday morning we were kind of thinking that, well, we've seen the end of it. That, you had one side sort of which attacked, the other side responded over the weekend, and then they said, well, this is it. We're not going to do anything more unless the other side retaliates. So markets were calm, even though yesterday we did sell off in response to the overall reaction. But this morning there is further fresh chances of escalation. So let me just tell you where things stand. It's geopolitics and data which are largely leading or rather driving markets right now and driving markets to the downside. So equities in the US slipped again. You have the S&P, which is down about 1.25%. The Nasdaq is down 1.7, 1.8%. And this is the comment from the geopolitical side, which more than anything else has really hurt sentiment. And it kind of has put markets on the edge, tentative, wait mode, whatever you want to call it. The Israeli defense minister has basically told the US Pentagon, which is the Department of Defense, that they've got no choice but to retaliate against Iran. And this is what markets did not want, right? Markets were kind of attributing very low possibility that both sides are going to go and de-escalate because of a variety of things. But I think this is kind of puts everyone on the watch out once again in terms of what will happen. Iran, for example, is again making comments that if we see an attack or retaliation from Israel, we're going to sort of respond in a very severe kind of a way. So it raises the prospects of a conflict, in the wider conflict in the region, one we've not seen for decades. I mean, between Israel and Iran, we've not had, something like this for a long 30, 40 years now. The other one was, of course, data. So US retail sales continue to be strong, which basically shows you that the consumer in the US is doing just fine, is healthy. And that ties in with what markets have been talking about, which is sort of delaying the first rate cut from the Fed because the economy is doing just fine and the quantum also being lower. So later and lesser in terms of rate cuts is what many are talking about. Actually, many sell-side economists are now saying that, well, perhaps no rate cuts at all in 2024. Technically as well, and I highlighted this over the last 2 days, the S&P E-mini, the S&P futures, which is the most liquid contract, that closed below the 55-day moving average for the first time since November. We'll watch for a weekly close. And if we get a weekly close below the 55-day moving average, you're basically looking at a test at the 200-day. That'll be about an 8.5% fall from where we are right now. So in the US as well, for the first time, we've not had a fall or correction at all. It looks like a little tentative. Now, the US 10-year, that jumped about 8 basis points. We're at 4.6. The dollar index rose once again, 106.15. You had oil prices which held steady at about 90.5. Gold prices were up. These are all sort of risk hedges, 23.80 as far as gold is concerned. Where do we go from here? We were saying this yesterday as well. You'll get the time to get in, but the situation is kind of fluid right now, so no harm in waiting. So as of yesterday's close, the 20-day is at 22,283. We closed just about 10 points under that particular level. So, I mean, of course, you'll get a lower start this morning. So on the way down, supports come in at 22,200, roughly. 22,204 to be precise, which is the 40-day exponential. And the 61.8% retracement of the rise, the full recent rise, is 22,117. So most likely, I mean, if this impulsive rise is over, you're looking at a test of about 22,100 or so. For the Bank Nifty, supports come in at the 20-day moving average, which is 47,432. And then the 40, which is 47,300. a similar kind of retracement, 61.8% retracement of the rise from 45,828 to 49,057 is 47,062. So are we kind of looking at that 61 point? I mean, I would actually more than the 40-day, I'd look at the 61.8 in both the Nifty and the Bank Nifty. For the Nifty, that number would be about 22,120. For the Bank Nifty, it's at about 47,100. Not very far, basically, by the way, another 1.5-2% or so, and you're there. And then we will decide what to do. The GIFT Nifty will come up on your screen, indicating about 190-odd point lower start. Sonia.
Oh, absolutely. And it's what, the second day that we're seeing, some amount of pressure, right? Not looking good at all in trade this morning. US markets continue to be under pressure. So even if you look at, the last couple of days, actually it's been the 6th straight session that the US markets, the Dow has been in the red. So there's definitely some caution in the system. You can call it because of the geopolitical reasons, because of the way gold has been surging. Crude prices have been higher. Asian markets continue to decline. So there's a steep fall in most Asian markets this morning as well on geopolitical concerns. Brent crude prices continue to be above $90 a barrel. Gold prices are firm. The 10-year Treasury yield is now at 4.61, which is the highest that we've seen since the month of November last year. And the CBOE Volatility Index, which is the CBOE VIX, which is the fear gauge, as we call it, has hit a 6-year high. So things are definitely not looking good in the system. But what do you do at a time like this? Remember, the Nifty is already down about 500 points from the 10th April high. We hit a high of somewhere around 22,750. The market has already lost about 500 points from there. So there is definitely some risk aversion that this market is seeing at the moment. Will it extend itself? Perhaps it could. There are a lot of individual stocks to watch out for as well in terms of result reactions. Tomorrow, of course, is a holiday, but on Thursday, you have Infosys, Bajaj Auto, HDFC Life that will be reporting their numbers. So keep an eye out on that. And for our own markets as well, both IT and banks, there could be some sell-off considering that, overall the market texture is on the weaker side. So maybe some safe haven buying in pharma names, etc. Consumer stocks too. Keep an eye out on those pockets. But otherwise, looks like it's going to be a very, very tricky start to trade today.
Well, that's right, Sonia. It's going to be a tricky start to trade. And, the last couple of sessions haven't been good. So I think from the low point of the day, maybe from the lows that we see in the first 90 minutes, I expect the bulls to come in with a bit of a fight. But the global cues, they ain't good. And, the troika is not looking very, very good. Whether you look at the dollar index, whether you look at the yields, or you look at Brent crude prices as well. So the troika, so to call it, is against us. So that's the problem pocket. What are the big cues for today? Well, you have a couple of weekly expiries that play out. Because tomorrow is, a holiday. So you'll have both the Nifty Bank as well as the Nifty Financial Services Index that will be playing out the weekly expiry today itself. So both those two on our radar. Well, what else are we looking at? Well, it appears that in the near term, there could be a preference for larger cap names in comparison to the broader market stocks, because some of those larger cap names yesterday, they were quite firm, and I'll get to that in just a bit. Now, the options data comes up for you in the screen. The 22,500 call, the 22,400 call, both of them were fairly active. And because of the, very aggressive writing that we saw at both these two strikes, the PCR just a few sessions ago was at around 1.3. That's come down to around 0.8. In the past, when the PCR moves down to around 0.65 to around 0.7, that's where we see a bit of a bounce. So let's see how that goes, but that's one of the indicators in there. The second indicator is a few sessions ago, I was pointing out that the FIs, well, they're going overtly net long. And you don't like a market that's devoid of shorts. Now that's turning around a little bit. Yesterday, they unbound longs big time and they added some shorts as well, which brings the long positioning now down to around 49%. And in absolute terms, the market was net short with close to around, the FIs with close to 35,000 contracts on the short side. That gradually turned around. We went to a net long position of close to around 51,000 contracts. But after the big swing that we saw of close to around 40,000 contracts, we are back down to being net short with close to around 5,000 contracts. Personally, I like a net short market because that's what gives you a reason to see a bit of a bounce. In terms of levels that I'm looking at, the Nifty is at the 20 DMA. And in fact, we'll be opening up gap down. So we'll be breaching that. But on a closing basis, I would like to see it close closer to this level. And the Nifty banks 300 points away from the 20 DMA. Normally, you see a bit of a bounce when the key indices hit the 20 DMA. So that's the index that I'm looking at. And as I said, the preference could be for large cap names. And yesterday, two stocks outperformed. You had Reliance Industries. It's holding at its 20 as well as 50 DMA. And Nestle as well was a relative outperformer. So I think the preference will continue even in today's trading session for the large cap names. If you pull up a chart, you'll see that Reliance Industries is hovering around the 20 and 50 DMA, and it's not breaching that mark. So that's the one that the bulls could turn to.
All right, thanks a lot, Nigel, for that. Well, plenty of market opinion as well coming through. So let's get straight to it now. These are tricky times for the market as we have geopolitical concerns. But how do you approach it? Mahesh Nandurkar of Jefferies says that FY24 is on track to be the best year since FY08 for Nifty EPS revisions versus the average 14% downgrade over the past decade. He says premium market valuations make the EPS revisions a key factor for stock performance. He also says their analysis shows a 72% correlation between the two. They trim weight in banks and cement on the downside risks and EPS estimates. They add ONGC and 360 to their model portfolio and also replace Max Health, ICICI Pru Life and Tata Steel with Apollo Hospitals, Max Life and Hindalco.
Upasana Shastra of Morgan Stanley says that they've updated the policy rate path and now expect easing in their forecast horizon. She says this is driven by change in the US Fed rate path and domestically strong growth, both warranting higher neutral real rates. She believes that improving productivity growth, rising investment rate and inflation tracking above the target of 4% alongside a higher terminal Fed funds rate warrant higher real rates. As such, she adds, they now expect no easing in policy rates in 2024-25 with policy rate steady at 6.5%, implying real rates to average about 2%.
Okay, and on the bonds, Vishal Goenka of IndiaBonds.com says no escalation news yet from the West Asia conflict was eclipsed by the blockbuster retail sales numbers in the US overnight, causing the US Treasury to continue its slide from last week. He says bond prices will remain under pressure today as the US dollar strengthens further globally with oil prices remaining firm. He expects the bond yields to widen with the 10-year benchmark bond yield trading in a range of 7.16 to 7.23%.
Well, let's run you through the list of top 10 stocks that we're tracking for you. We're looking at Cipla, Happy Fortunes, All Cargo Terminals, you have Geo Financial Services, GTPL Hathway, Transformers and Rectifiers, as well as Interglobe Aviation. All of them will be reacting to positive news flow. On the flip side, you have LTI, Mindtree, ONGC and Oil India will be reacting to negative news flow.